What's up everybody, I am Jaspreet Singh, and index funds are the holy grail of investing, but for the last few years, experts have been issuing warnings about a potential bubble brewing in the index fund market. They're saying that with more and more people passively investing their money into index funds, we're starting to see a bubble forming, and you have legendary investors like Peter Lynch saying that this is going to become very dangerous, and even Michael Burry has come out and said that there's an index fund bubble that might crash, and some people have gone as far as saying that index funds could be worse than Marxism. So what I want to do today is talk about what's going on, then go over what an index fund is, and then talk about if we're actually in a bubble or not. So let's talk about what's actually going on. If you want to make money in the stock market, all you have to do is buy low, sell high. And if you look at the stock market charts of the Dow Jones or the Nasdaq and the S&P 500, it looks like we're at the highs. Index funds make it very easy for regular people to get exposure to the stock market because the average person doesn't know how to start investing, they don't know how to research companies, and they don't know where to put their money. And so instead of trying to do all of the research, you can just invest your money into an index fund, which is a basket of stocks. An index fund is a group of companies where now you're not investing in one company, you're investing into a whole bunch of companies. For example, one of the most popular indexes is the S&P 500, which is a group of the 500 biggest companies on the stock market. Now, if you wanted to invest in all 500 of these companies, you could go out, open up a brokerage account with Robinhood or whoever, and then you would have to buy 500 different companies, which is a lot of work, a lot of time, and it's a lot of research. But instead of trying to do all of that, you can just buy shares of one index fund, and now you're getting exposure to all 500 companies. So let me start by talking about why some experts think that we have a bubble in index funds. Michael Burry is the investor who built his fortune and his fame after the 2008 crash because he was one of the few people that shorted the housing market before the 2008 crash, and when the whole bubble burst, he made a fortune. He was the person that they based the movie The Big Short off of. He says that we have a massive index fund bubble brewing because of three reasons. One is because of asset prices, two is because of price discovery, and three is because of something he calls small exit door. So I'll go over what all three of these things are. First, starting with asset prices, if you look at the stock market, you can look at the Dow Jones, the Nasdaq, the S&P 500, you'll see that all of these charts are at very high points. They're all near their record highs, which if you're trying to buy low, sell high, might not make sense to buy at the peak. The way most people invest in index funds is through a passive strategy, where every week or every 2 weeks or every month, you're going to have some money automatically invested into index funds. And so if market prices are at record highs and they could be potentially going lower future, that means that a lot of people are buying index funds today at a very high price. Or at least that's what Michael Burry says. That's part of the reason why Michael Burry is relating index funds today to the housing market back in 2008. He says that index funds today are kind of like the CDOs that we saw back in 2008. Now this might seem kind of weird. How can you relate index funds where people are just passively investing their money without going into debt, without over leveraging to buy these index funds, but to give you exposure to companies in the United States? How can you relate that to the 2008 housing market bubble where you had all these risky loans being made, you had all these subprime loans, you had adjustable rate mortgages, and you had so many other things happening at the bank levels creating this financial bubble? How are they in any way similar? What Michael Burry says is due to something called price discovery, which is the second reason why he says that we are in an index fund bubble. When you are passively investing your money, you're not actively shopping around. You just let the machine do its thing, and every week, every 2 weeks, or every month, your money is actively being invested into passive index funds. And so what Michael Burry says is that this is creating a bubble because it doesn't create any sort of price shopping. Everybody is just investing their money into these index funds, and they have no idea what they're buying or at what price they're buying. When you go shopping for anything, whether it's groceries or a laptop or a cell phone or a vacation, you're gonna price shop. You're gonna see what the price of your item is, and then you're gonna buy something that you think is a good price. If it's not a good price, you might not buy it. But when you're buying these index funds passively, you're not doing that. You just have it on autopilot, and no matter what the price is for the companies that you're investing in, you're just buying it. That wouldn't be such a big problem if only a few people were passively buying index funds, but that's not the case. Right now, half of all the money that's invested into funds is invested in index funds, and that means upwards of 30% of every dollar invested in the stock market today is invested in index funds. And considering the United States stock market has a total market capitalization of over $50 trillion, that's a lot of money tied up in index funds that are potentially overvalued. So what Michael Burry is saying, because nobody is shopping around, they're just blindly throwing their money into these index funds. Your money is going into this fund, which is indirectly going into these smaller companies, which means that you have a lot of companies which may not be worth the value that they are, getting a whole bunch of investment dollars just because they happen to be lucky enough to be in a big fund. Going back to the companies in the S&P 500. If we go all the way down on the list, that means News Corp Class B is getting money invested into it just because it is in the S&P 500, not because people actually want to own it. This brings Michael Burry to his third concern, which is the small exit door theory. Think of it like this. I'm here recording in this small recording room, and if I wanted to leave, I can just walk out of the exit door. But now let's assume that there isn't just one Jasprit in this room. There's 100 Jasprits in this small recording room, and we see a small fire start to burn over there, and now we have to run out. Now there's a lot of us in an enclosed space with one door to get out, and there's gonna be a big rush trying to get out of the room, which means it's gonna be a very inefficient way out, and somebody might get hurt. You better watch out, Jasprit number 74. If people started to sell their index funds, Michael Burry says that this will create a fire sale, which will ultimately cause the price of these index funds to collapse because you have so many people buying these index funds without knowing what they're buying, and because of that, it's become so overvalued. And now that it is so overvalued, if people started to sell, it would cause a big domino effect, causing the price of index funds to ultimately collapse. He says that that is especially true for the smaller companies because these smaller companies are getting a lot of investment dollars coming in just because they happen to be in an index. And so if you're fortunate enough to be in one of these bigger indexes, well, now you're getting a lot of investment dollars coming in, which wouldn't be there otherwise because people aren't looking for News Corp B. And so if it wasn't in that index, you wouldn't have these dollars coming in. And so if people started to sell the index, well, now these smaller companies, which wouldn't have investment dollars come in otherwise, would then collapse because nobody wants to buy them. So that's why Michael Burry thinks that we are in this massive index fund bubble, and not surprisingly, not everybody agrees. Like Warren Buffett. Warren Buffett is also a very successful investor, and he's arguably one of the most successful investors in history, and he's one of the biggest proponents of index funds. He says that everyday people should be investing in index funds, and the index funds are the best investment for 99% of the population. Warren Buffett's theory is that most regular people are not going to be able to beat the market, especially considering the fact that most highly paid, highly educated hedge fund managers cannot beat the market for the long term. So instead of trying to beat the market and being upset when you lose, he says that you can just get exposure to the general economy by just putting your money into index funds and letting the economy and the stock market do its thing, because now you can have an upside of the American economy. The best index fund that Warren Buffett recommends is an index fund that gives you exposure to the S&P 500, which again is the 500 biggest companies on the stock market, which now is actually a little bit more than 500 companies, but in general, everybody calls the S&P 500 the biggest 500 companies on the stock market. So who's right, Warren Buffett or Michael Burry? There's no doubt that our stock market was inflated thanks to the 2020 pandemic, because we saw first that the Federal Reserve Bank printed something around $13 trillion to help stimulate the economy, and then they slashed interest rates to 0% to also stimulate the economy, and then they announced massive amounts of quantitative easing to help prop up the markets. All of these things diluted the value of the dollar, and they inflated the value of the stock market, which has people worried about a potential stock market bubble, which would also translate to a bubble in the index fund market, because when you invest in index funds, you're getting exposure to the stock market. But let's go back to Michael Burry's arguments of high asset prices and the lack of price discovery and the small exit door theory. When we're looking at asset prices, especially for a long-term investment, you'd expect it to go up. Even if you go back to the stock market charts, you'll see that the stock market crashed in 2020, you saw it crash in 2008, you saw it crash in 2001, and we've seen a number of crashes before that. But each time after these crashes, we've seen the stock market turn around, and we've seen the stock market grow even higher because we have a robust economy where our economy has been able to grow. I'm a big believer in the American economy. I think we have the strongest economy in the world. I do think that we have issues in the economy, but I still think that we have the strongest economy in the world, and I think that we're going to continue growing as an economy. Now, while the stock market and the economy aren't linearly linked, they are connected. So if we see a growing economy, you can expect to see a growing stock market. If you're investing your money for the long term and you're passively investing your money into index funds or something similar, well, there's going to be periods when the market is up and the market is down, and the whole idea is you're just going to keep consistently investing your money. So even though asset prices are high, that's not going to discourage me from investing in things like index funds, because I'm investing my money for the long term, and if it goes down, well, that's just another opportunity for me to buy even more aggressively. Yes, the stock market's high today, but I think the stock market is going to continue to climb higher decade after decade after decade. That doesn't mean it's going to go straight up. We might see up and down and up and down, but overall, I think we're going to continue to see the stock market grow and climb like we've seen it happen for the last 100 years. Second has to do with the price discovery argument, where now the prices of companies are inflated because they happen to be in these indexes which have a lot of money flowing into them. I think that's partially true. I mean, if a company is in an index, it's going to naturally get more money flowing into its investments because it's in that index. but there's a couple things you gotta know. For one, it's not easy to join some of these indexes because they have rules and requirements. Like to join the S&P 500 index, you have to be one of the 500 biggest companies on the stock market. And if we go all the way down on that list, you'll see News Corp with a market capitalization of over $13 billion. And second, when an index fund invests into these different companies, they don't invest into them in the same ratio. They invest into the bigger companies at a bigger percentage, and they invest a lot less money into the smaller companies. And we've seen research done on this as well, which shows that yes, when a company is added to an index fund, it could see a boost in the stock price in the short term, but over the long term, it really doesn't make that much difference in the actual stock price itself. And third, when we're talking about the small exit door theory, where if everybody started selling the index funds, you would see a crash in the stock market. Well, that happens across asset classes. That's not anything new to index funds, because if anybody started panic selling anything, you would see the price of the asset fall. Michael Burry is a very smart person, and he's made a lot of money and he's seen a lot of success in the stock market, but he's relating the index fund bubble to what we saw happen in the real estate market, where people were over leveraged, they were borrowing money up to their eyeballs, and then they went underwater, which is why they were forced to sell. And then you had a lot of people taking out loans that they couldn't even afford because they were able to qualify for these subprime mortgages. And so it becomes difficult to analogize that to people just investing a small piece of their paycheck into index funds every time you get paid, especially since people aren't over leveraging their index funds the way that they were doing houses back before the 2008 crash. Plus, I think investors are smarter today than they were 15 years ago, because if you look at the stock market crash of 2020, you'll see that as soon as the crash happened, hedge funds got scared, but regular people, retail investors, started opening up investment accounts and they started buying because they saw it as an opportunity. We didn't see that happen after the 2008 crash. So if and when we see the next crash in the stock market, that will trickle down to the index fund market, which means index funds will crash. But I think a lot of people would realize that that would be a great opportunity for you to come in and buy these companies, buy these funds at a discounted price. Now, of course, my answer might be a little bit biased. I personally am not a huge fan of index funds. I prefer ETFs. ETFs work a little bit differently than index funds, but they give you exposure to the same companies. I'll explain what the difference is in just a second. But I invest my money into ETFs that give me exposure to the S&P 500, and this happens every single week. Like I said, I'm a believer in our economy, and if our economy continues to grow, that would mean that our stock market would also grow. Does this mean that we're going to see the stock market go straight up? No, we could see a stock market crash happen. If a stock market crash happens, I'll just buy more aggressively. So I'm not worried about a bubble, because if we were to see a crash, it's just an opportunity for me to come in and buy even more. I use a platform called M1 Finance to passively invest my money into ETFs. They're a sponsor of Minority Mindset, but if you want to see how it works and see how you can invest your money passively, I'll put the link to how you can do that with our sponsor M1 Finance in the description below. If you want to invest in the index fund, you have to go to a company like Vanguard or Charles Schwab or Fidelity, which offers an index fund, and then you can buy shares of the index fund, which gives you exposure to, say, the 500 biggest companies in the stock market. Three of the most popular S&P 500 index funds are VFIAX, which is the Vanguard Index Fund, SWPPX, which is the Charles Schwab Index Fund, and FXAIX, which is the Fidelity Index Funds, and all of these are index funds that give you exposure to the S&P 500. The difference between an index fund and an ETF is that index funds oftentimes have a minimum amount of money that you have to invest if you want to buy one of the index funds, and you also have restrictions on how often you can trade your index funds, because many index funds let you make only one trade per day, meaning you can only buy or sell the index fund once a day, and that's it, versus ETFs work very similarly. They have very low fees, just like index funds. However, they trade just like stocks. So if you find an ETF that gives you exposure to the S&P 500, well, then you can buy and sell these ETFs whenever you want. You don't have the same restrictions as index funds, and you also don't have any minimum investment amounts for ETFs like you do in index funds. A couple examples of these ETFs are VOO, which is the Vanguard ETF for the S&P 500, and then SPY, which is the Spider ETF for the S&P 500. Now, I have to give you a little bit of a disclaimer that I also have my own money invested into VOO. Now, of course, you got to decide what's right for you. I don't want you to blindly copy what I do, because my strategy is not your strategy, my goals are not your goals, and you got to figure out if you like the idea of investing in ETFs or index funds, which one is better, or if you like the idea of investing in funds at all. Maybe you want to be purely an active investor, or maybe you want to be purely a passive investor. I personally have my passive investments and my active investments. The way you buy ETFs and index funds is also going to be a little bit different, because a lot of times you're going to have to go directly to the company selling an index fund to buy an index fund, or at least that'll be the easiest way. Like if you wanted to buy the Vanguard Index Fund, VFIAX, you could just go onto the Vanguard website and then you could buy it there, and you'll also see that there's a $3,000 minimum to buy the Vanguard Index Fund. If you go to the Charles Schwab or the Fidelity website, you'll see that both of those index funds have no minimums to invest in them over there. Buying and selling shares of an ETF is easier than buying and selling shares of an index fund because now you can go to pretty much any stock brokerage out there and buy shares of your ETF. Now, if you're one of those people that can't really handle your emotions, that if you see the stock market go down, you might be more tempted to sell, then maybe an index fund is better for you because index funds are there to manage your risk and to manage your emotion, because now you're limited to how easily that you can sell your index fund. So if you're worried about potentially selling if you see a down market, then maybe you should go with index funds. If you want more control and you want to be able to buy your funds whenever you want from whatever brokerage you want, then maybe ETFs are a better option for you. The key for either of these to work is you have to know your strategy, know your goals, and then continue to invest your money based off your strategy, even when things don't necessarily make any sense. And this is why it pays to be financially educated. What's up, everybody? If you want to continue building your financial education, I linked a relevant video here that I think you'll love, and as an added bonus, I have a free guide on how you can start generating passive income that you can download and read for free. All you gotta do is click that button below. Let's go over the Federal Reserve Bank's goals, because the Fed is the secret little entity